The window's closing. Not next month, not next week, Monday. For years, we have watched the paper markets lie to us. We have watched the spot price flash across our screens while the real world told a completely different story. We have tracked the premiums. We have monitored the dealer inventories. We have whispered to each other in forums and comment sections that one day, the paper price and the physical price would divorce so violently that even the mainstream financial media would be forced to acknowledge the fraud. That day is not coming. That day is here. Right now, as I record this, the spot price of silver is showing $82.47 on the COMEX futures screen. That is the number that Bloomberg will report. That is the number that CNBC will flash across the ticker. That is the lie. But if you pick up the phone right now and call any major bullion dealer in North America, if you try to buy a single monster box of American Silver Eagles, you will be quoted a price north of $95 per ounce. And that is if they have any left. Most don't. The premium has exploded to $13 over spot. In some cases, $15. For certain sovereign coins, we are seeing $18 premiums. This is not a markup. This is not dealer greed. This is the market screaming at you that the paper price is a fiction. A $13 premium represents a 16% disconnect between what the futures market says silver is worth and what the physical market is actually paying. That is not noise. That is not a rounding error. That is the collapse of the pricing mechanism that has suppressed this metal for 4 decades. And you have 48 hours to act before the window slams shut. Monday morning, the institutional money returns from the weekend. Monday morning, the algorithms wake up to a market that is fundamentally broken. Monday morning, the dealers who are currently selling at $95 will either raise their prices to $110 or they will simply put up the sold out sign. Stop watching. Start acting. Welcome to Chronicles of Currency. I'm your host, and this is the channel where we decode the monetary signals that the mainstream refuses to translate. We don't just report the numbers, we tell you what the numbers mean for your purchasing power, your savings, and your financial survival. And right now, the numbers are telling a story that should terrify anyone holding paper assets and electrify anyone holding physical metal. While you were sleeping last night, while the American markets were closed and the trading desks were dark, something extraordinary happened in the Asian session. Silver didn't just rally, it gapped. It teleported from $79 to $82 in a single 4-hour candle, on volume that exceeded the entire previous week. But the real story isn't on the charts. The real story is in the phone calls. It's in the frantic emails between dealers. It's in the wholesale market where the entities that actually move metal are paying prices that make the spot quote look like a joke from 2020. I spent the last 6 hours on the phone with 3 different wholesale contacts. One in Dallas, one in Toronto, one in Zurich. The message was identical from all 3. We cannot source metal at these prices. The pipeline is empty. The refiners are backed up. The sovereign mints are rationing allocations. If you want physical silver right now, you pay the real price, not the screen price. The real price is $95. The screen price is $82. That $13 gap is the crack in the dam. And on Monday, the flood comes through. Let me show you exactly why this is happening, what it means, and how you can position yourself on the right side of history in the next 48 hours. Let's start with the raw data, because I want you to understand that I am not speculating. I am not guessing. I am reading you the receipts. I pulled the current retail prices from 6 major online dealers as of 4 p.m. Eastern today. These are not negotiated prices. These are the prices listed on their websites for immediate purchase. SD Bullion, American Silver Eagle, $97.43 per coin. That represents an $14.96 premium over the spot price of $82.47. JM Bullion, same coin, $96.89, premium of $14.42. APMEX, $98.12, premium of $15.65. Money Metals Exchange, $95.67, premium of $13.20. Bold Precious Metals, showing out of stock on Eagles entirely. Silver Gold Bull Canada, $99.14 CAD, which translates to approximately $94.50 USD after exchange. Now, let's look at generic rounds, the cheapest form of silver you can buy. These should trade at spot plus maybe $1 or $2. That's the historical norm. Generic rounds are currently listed at $86 to $88 at every major dealer. That is a $4 to $6 premium on a product that normally carries a 50-cent premium. This is not normal. This has never been normal. Even during the 2020 COVID squeeze, when silver spiked from $12 to $30, the premiums never sustained at these levels for more than a few days. We are now entering week 3 of double-digit premiums with no relief in sight. But here's what really sent chills down my spine. I called my wholesale contact in Dallas. This is someone who moves pallets, not tubes. He sells to dealers, not to retail. He is the layer beneath the layer you see. He told me that the wholesale price for 1,000-ounce bars, the institutional product, the COMEX deliverable bars, has completely disconnected from the futures price. He is paying $89 per ounce for bars that the futures market says are worth $82. Let me repeat that. The wholesale market, the market that is supposed to set the price for everyone else, is trading at an $7 premium to the futures market. This means the futures market is no longer discovering the price. It is broadcasting a fantasy, while the real market operates on a completely different plane of reality. When the wholesale market diverges from the futures market, it means one of two things. Either the futures market corrects upward violently to match reality, or the futures market loses all credibility and becomes irrelevant. Both outcomes are catastrophic for anyone short silver. Both outcomes are spectacular for anyone long physical. The London Bullion Market Association, the LBMA, is reporting similar stress. Their forward rates have gone negative, meaning that traders are paying a premium to get silver now rather than later. That is backwardation, the signature of a physical shortage. Shanghai is worse. The Shanghai Gold Exchange is quoting silver at prices that translate to $97 to $99 USD, even higher than what American dealers are charging. Chinese industrial buyers are so desperate that they are paying a 20% premium over COMEX just to secure supply. Connect these dots. American dealers paying $95, wholesale at $89, London in backwardation, Shanghai at $99. The entire global physical market has abandoned the paper price. They are trading in a parallel universe where the real supply-demand dynamics set the value, not the leveraged bets of a few too-big-to-fail banks. The paper market is a dead man walking. It just doesn't know it yet. And in 48 hours, when Monday arrives, the collision between paper and physical will create a pricing supernova that most investors are completely unprepared for. I need to stop here and make sure everyone understands why this premium explosion is the most important signal in the entire precious metals market right now. Because if you don't understand premiums, you will misread the situation completely. The spot price of silver is not the price of silver. I need you to repeat that to yourself until it becomes instinct. The spot price is the price of a futures contract on the COMEX exchange. It is the price of a promise to deliver silver at some point in the future. It is paper. It is electronic. It is leveraged 100 to 1 in some cases. And most critically, it can be manipulated by entities with deep enough pockets to absorb temporary losses. The physical price, the price you actually pay when you walk into a dealer and walk out with metal in your hand, is the real price. It is the price set by actual supply meeting actual demand with no leverage, no paper, no games. In a healthy market, these two prices track each other closely. The premium over spot should be small, maybe 3% to 5%, representing the cost of fabrication, transportation, and dealer margin. When the premium explodes to 15% or 20%, it means one thing and one thing only. The paper market is lying, and the physical market is telling the truth. Think of it like this. Imagine there are two prices for gasoline. One price is set by traders in New York who bet on future oil deliveries. The other price is what you actually pay at the pump. Normally these prices are close, but imagine if the New York price said gasoline was $3 per gallon, while every gas station in America was charging $4. You would immediately understand that the New York price was meaningless. You would understand that the real price, the price that matters for your life, is $4. That is exactly what is happening in silver right now. The New York price, the COMEX price, says $82. The gas station price, the dealer price, says $95 to $100. Which price is real? Which price matters? Which price should you use to make your decisions? The answer is obvious, but the mainstream financial media continues to report the COMEX price as if it means something. They continue to show you the $82 number and tell you that's what silver is worth. They are either ignorant or complicit. I will let you decide which. Now, why is this happening? Why has the premium exploded right now? 3 reasons. First, the supply chain is broken. The sovereign mints, the US Mint, the Royal Canadian Mint, the Perth Mint, they cannot get enough raw silver to meet demand. The refiners are backordered. The mines are producing at capacity, but the demand is outpacing supply by a factor that has never been seen before. Second, the industrial buyers are panicking. Silver is not just a monetary metal, it is an industrial necessity. Solar panels, electric vehicles, 5G infrastructure, military applications. The industrial users are realizing that the just-in-time supply chain has failed, and they are hoarding metal to secure their production lines. Every ounce they take is an ounce that doesn't make it to the retail market. Third, and most importantly, the paper shorts are losing control. For decades, the bullion banks have suppressed the price by selling paper contracts in quantities that dwarf the physical supply. But paper selling only works if nobody calls the bluff, if nobody demands delivery. The moment buyers start demanding physical metal instead of paper settlement, the game ends. That moment is now. The 48-hour window I keep referencing is the gap between this weekend, when the paper markets are closed, and Monday morning, when the institutional players must face the reality of a market that is repriced around them. If you wait until Monday to act, you will be competing with hedge funds, sovereign wealth funds, and industrial buyers who have unlimited capital and unlimited desperation. If you act now, you lock in the $95 price that will look like a gift when silver is $120 and unavailable. The premium is the signal. The signal is screaming. Let me connect this premium explosion to what is happening inside the COMEX vaults right now, because the premium is not an isolated phenomenon. It is a symptom of a deeper disease. The COMEX is supposed to be the exchange where silver is bought and sold at the official price. It is supposed to be backed by physical metal sitting in approved vaults in New York. When you buy a futures contract, you are theoretically buying a claim on real metal. But here's the problem. The registered inventories in the COMEX vaults, the metal that is actually available for delivery against contracts, has collapsed to levels not seen since the 1990s. As of the most recent report, the registered category contains approximately 29 million ounces. Sounds like a lot, right? It's not. The open interest in silver futures, the total number of contracts outstanding, represents a claim on over 400 million ounces. Do the math. 400 million ounces of paper claims. 29 million ounces of deliverable metal. That is a leverage ratio of nearly 14 to 1. For every ounce of real silver in the vault, there are 14 paper claims pretending to be silver. This is the definition of a fractional reserve system. And just like a fractional reserve bank, it works great until everyone shows up at once demanding their money. That run on the vault is happening right now. This month's delivery notices have shattered records. We are seeing standing delivery demands that exceed the available registered inventory. Traders are not rolling their contracts to the next month. They are standing for physical metal. The clearinghouse is scrambling. They are offering cash premiums to settle contracts. They are begging longs to take cash instead of metal. In some cases, they are reportedly offering 10% over spot to avoid physical settlement. Why would they pay 10% over spot to avoid delivering silver? Because they don't have the silver to deliver. This is the moment the premium on the retail market is pricing in. The dealers know that the wholesale market is being drained. The wholesale market knows that the COMEX is being drained. The COMEX knows that the registered inventory cannot cover the delivery demands. Everyone in the chain is scrambling to secure physical metal before the music stops. And you, the retail investor, are at the end of that chain. When the COMEX defaults, and I use the word when deliberately, the fallback will be forced cash settlement. The paper holders will get dollars. The physical holders will get wealth. This is why the premium exists. It is the market pricing and the probability of a delivery failure. It is the market saying that a paper claim is worth $82, but actual metal in your hand is worth $95 or more. The 48-hour window is your chance to convert paper into metal before the window closes. On Monday, when the delivery demands intensify, when the institutional buyers return hungry from the weekend, the premium will either explode higher or the dealers will simply stop selling. Both outcomes mean the same thing for you. If you don't own it by Sunday night, you might not own it at all. Let me walk you through the mathematics of what is about to happen, because I want you to understand that the $95 dealer price is not the ceiling. It is the floor. We need to calculate the true price of silver based on physical reality, not paper fiction. Start with the annual supply. Global silver mining production is approximately 830 million ounces per year. Add another 180 million ounces from recycling and scrap. Total available supply, roughly 1 billion ounces annually. Now look at the demand. Industrial demand has surged to 680 million ounces annually. This is driven by solar panel manufacturing, electric vehicle production, 5G infrastructure, and medical applications. Unlike investment demand, industrial demand is price inelastic. A solar panel manufacturer doesn't stop buying silver because the price went up. They need the silver to make the product. They pay whatever the market demands. Investment demand, including coins, bars, and ETF inflows, adds another 300 million ounces. Total demand? 980 million ounces against 1 billion ounces of supply. On the surface, that looks balanced. But here's what the simple math misses. Above-ground stockpiles are depleted. The strategic reserves that used to cushion supply shocks have been drawn down for decades. There is no buffer left. The 680 million ounces of industrial demand is growing at 8% to 10% per year. The mining supply is flat or declining because there has been almost no investment in new silver mines for a decade. The miners can't turn on new supply. It takes 7 to 10 years to bring a new mine online. When demand grows faster than supply and there is no stockpile to raid, the price must rise to ration demand. How high must it rise? Let's calculate. At $82 per ounce, the total value of annual silver production is about $82 billion, but the solar industry alone is projected to demand $100 billion worth of silver annually by 2030. Do you see the mathematical impossibility? If one single industry needs more silver than the entire mining supply is worth at current prices, the price must rise dramatically to either increase supply or decrease demand. Let's model a supply response. For silver mining to increase by 20%, the price would need to sustain above $100 per ounce to make marginal deposits economically viable. That takes years to materialize. Let's model a demand response. For industrial demand to decline, the price would need to rise high enough that manufacturers start substituting other materials. For most applications, that substitution threshold is estimated at $150 to $200 per ounce. The equilibrium price, the price where supply and demand balance without stockpile depletion, is somewhere between $120 and $180 per ounce. That is not a speculative fantasy. That is pure math. Now factor in the monetary premium. Silver is not just an industrial metal. It is a monetary metal. It has been money for 5,000 years. In a currency crisis, which is exactly what we are entering, silver attracts flight capital from the bond market and the currency market. If just 1% of global bond market capital flows into silver, that is $1 trillion chasing a market worth $80 billion. The price impact would be vertical. The $95 that dealers are charging today is not expensive. It is the last bargain before the market reprices to its true equilibrium, and you have 48 hours to take advantage of it. Now I need to address the elephant in the room. If the true value of silver is $120 or $150 or $180, why does the COMEX show $80? Because the paper market is controlled by a handful of institutions that have a vested interest in suppressing the price. This is not conspiracy theory. This is documented fact. In 2020, JP Morgan paid a $920 million fine to settle charges of manipulating the precious metals market. The Department of Justice proved that their traders engaged in spoofing, the practice of placing fake orders to move the price and then canceling them before execution. In 2022, additional banks were fined for similar practices. The manipulation is not alleged, it is admitted, it is paid for. It is a cost of doing business for institutions that profit from suppressing the monetary metals. Why would they want a lower silver price? Because silver is the canary in the coal mine for currency debasement. If silver is rising, it signals that the dollar is falling. It signals that inflation is real. It signals that the Federal Reserve's policies are failing. A rising silver price is a vote of no confidence in the fiat currency system. The banks that profit from that system, the same banks that hold trillions in dollar-denominated assets, have every incentive to keep silver quiet. They do this by selling unlimited paper contracts. They don't need to own the silver, they just need to create the illusion of supply by flooding the market with paper promises. But paper promises have a weakness. They can be called. When a buyer stands for delivery, when they say, I don't want cash, I want the metal, the paper game ends. That is what is happening right now. The delivery demands are overwhelming the paper supply. The longs are calling the bluff. They're saying, show me the silver. And the banks can't show it because they don't have it. This is why the premium is exploding. The dealers who deal in physical reality are pricing in the failure of the paper system. They are saying, we know the COMEX is a fiction. We know the real price is higher, and we are going to charge accordingly. The 48-hour window is the last gasp of the paper price. On Monday, when the delivery notices stack higher and the registered inventory drops lower, the COMEX will face a binary choice. Raise the price to ration demand, or default on delivery obligations. Either outcome validates the physical holders and destroys the paper shorts. The manipulation is ending not because the regulators intervened, not because the banks grew a conscience. It is ending because the physical market has finally overpowered the paper market. Supply and demand always win in the end, always. And in 48 hours, you are going to witness that victory. Let me paint the picture of what Monday morning looks like if you understand the forces in play. The Asian markets open first: Shanghai, Hong Kong, Singapore. These markets have been paying $95 to $99 for silver all week, while the American market slept. They are hungry, they are aggressive, they are backed by central bank policy that is actively encouraging the accumulation of hard assets. When the Shanghai session opens, they will look at the weekend news. They will see that the American premiums have exploded to match their prices. They will interpret this correctly as a sign that the global market is finally repricing. What do you think they will do? They will buy more, not less, more. Because in a shortage, higher prices do not suppress demand, they increase it. Buyers panic. They fear missing out. They accelerate their purchases to secure supply before it's gone. This is the doom loop of a physical shortage. Price rises, demand increases, supply cannot respond. Price rises further, demand increases further. By the time the London market opens, 4 hours later, the Asian buying will have pushed spot prices higher. The London traders will see silver trading at $85 or $87 in the Asian session, and they will face a choice: sell into the rally and risk being caught short in a delivery squeeze, or buy to cover their existing short positions before the losses become fatal. Most will choose to cover because they saw what happened to the banks that didn't cover. They saw the $17 billion repo spike from last week. They saw JP Morgan's internal memo warning traders to reduce commodity exposure. The covering rally in London will push prices to $90 before New York even wakes up. And then the American market opens. The retail investor turns on CNBC and sees silver up $8 overnight. The headline reads, "Silver surges on supply fears." The Robinhood traders pile in. The Wall Street bets crowd smells blood, but they can't buy physical at $90 spot because the dealers have already adjusted their prices. The $95 premium from Friday is now a $98 premium, or $102. Or the dealer website simply shows inventory unavailable. The retail demand crashes into a wall of zero supply. This pushes the premium even higher because the few dealers with remaining inventory can name their price. Simultaneously, the COMEX opens and the delivery queue lengthens. The traders who wanted to roll their contracts see the chaos and decide to stand for delivery instead. Why accept a cash settlement at $90 when the street price is $100? The registered inventory, already at critically low levels, starts to evaporate. By Monday afternoon, the COMEX will be facing a full-blown delivery crisis. They will have two options. Option one, allow the price to rise until it rations demand. This means spot silver at $100, $110, or higher within days. Option two, declare force majeure. Settle all contracts in cash at a fixed price. Admit that the exchange cannot fulfill its basic function of delivering metal against contracts. Either option is nuclear for the short sellers. Either option is a moonshot for the physical holders. And you are sitting here on a Saturday with 48 hours to position yourself before this cascade begins. The dealers are still selling. The premiums are high, but the metal is available. By Monday, that may not be true. The window is closing. I cannot make you walk through it, but I can tell you what's on the other side. Before I give you the roadmap for the next week, I need to stop and acknowledge something. If you are watching this channel, if you have been following the Chronicles of Currency, if you have been stacking silver despite the mockery of your coworkers and the eye rolls of your financial advisor, you need to hear this. You were right. For years, they told you silver was a pet rock. They told you that the futures market was efficient. They told you that the price on the screen was the real price, and you were a fool for paying premiums. They were wrong. You were right. The premium explosion we are witnessing is not a market anomaly. It is the market admitting that the physical stackers understood something the paper traders didn't. Real things have value. Paper promises are worthless. You understood that holding metal in your hand is different from holding a claim in a computer. You understood that counterparty risk is real. You understood that systems fail and preparation matters. The $95 price is your vindication. It is the market finally agreeing with the thesis you have held for years, sometimes decades. But this is not the time to gloat. This is the time to prepare. Because the move from $82 to $95 is just the beginning. The move from $95 to $150 is coming. And the move from $150 to $300 is not impossible if the monetary system enters the crisis that many of us believe is inevitable. You have been right so far. Stay right. Hold your position. Add to your position if you can. Do not let the volatility shake you out. The paper world is dying. The physical world is being reborn, and you are on the right side of history. Let me give you a practical action plan for the next 48 hours. First priority, secure physical metal before Monday. If you have cash available, do not wait. The dealers who are selling at $95 today may not be selling at all on Monday, or they may be selling at $110. The premium is the cost of certainty. Call your local coin shop first thing tomorrow morning. Many are open on Saturdays. Ask what they have in stock. Do not haggle over $2 when the price might be $20 higher in a week. If local options are exhausted, go online. SD Bullion, JM Bullion, Money Metals Exchange, order immediately. Even if shipping takes a week, you will have locked in today's price. Do not wait for a dip. The dip is a paper phenomenon. The physical market doesn't dip when there's a shortage, it gaps higher. Second priority, if you cannot get physical, secure allocated storage. Services like Kinesis, One Gold, or allocated programs at major dealers allow you to buy metal that is stored in professional vaults, but legally belongs to you. This is not as good as holding it in your hand, but it is infinitely better than paper ETFs. Do not buy SLV, do not buy paper silver. The tracking error between paper silver and physical silver is about to explode. The ETFs will lag the physical price by 10%, 15%, or more because they cannot source metal to match inflows. Third priority, prepare for volatility. Monday will be chaotic. The paper price might spike and crash. The algorithms will try to shake out weak hands. There may be flash crashes designed to trigger stop losses. Ignore the screen. Watch the premium instead. If the dealer premium holds at $10 or higher, while the paper price crash is $5, that tells you the crash is fake. The physical market is not selling. Only the paper market is selling. Fourth priority. Do not sell your physical metal into this rally. I know it's tempting. You bought it $25 or $30 and it's now $82 on the screen, $95 in reality. You want to take profits. Don't. This is not the top. This is the breakout. Selling now is like selling Bitcoin at $1,000 because it went up from 100. You will regret it for the rest of your life. If you need liquidity, borrow against your metal. Several firms now offer precious metals-backed loans. You keep the metal, you get the cash, you ride the rest of the rally. Fifth priority, spread the word. Send this video to someone you care about. Someone who has their savings in a bank account earning 4% while inflation runs 8%. Someone who trusts the system because they've never been given a reason not to. The 48-hour window is closing for them too. They deserve the chance to walk through it. Let me leave you with this. History is punctuated by moments where the old system cracks and the new system emerges. These moments are rarely announced in advance. They do not come with press conferences or calendar invites. They come on quiet weekends when the markets are closed and the analysts are sleeping. They come as premiums that explode before the spot price catches up. They come as whispers in the wholesale market that the pipeline is empty. We are in that moment. The $13 premium is not a bug. It is a feature. It is the market. As a way of telling you that the paper system has failed and the physical system is repricing. Monday morning, the institutional world will wake up to this reality. They will scramble to position themselves. They will call their prime brokers and demand physical allocations. They will overwhelm the same dealers that are currently selling to you at $95. You have a 48-hour head start. Use it. I'm not telling you what to do with your money. I'm not a financial advisor. I'm a chronicler of currency, a student of monetary history, and a witness to the greatest repricing event of our generation. What I can tell you is what the data says. The data says the physical market has divorced from the paper market. The data says the delivery mechanism is breaking down. The data says the premiums are pricing in a future that most investors have not yet imagined. The data says the 48-hour window is real and it closes Monday. What you do with that information is your choice. But when you look back on this moment, when you tell your children or grandchildren about the great monetary reset of the 2020s, you will remember where you were when the premium hit $13. You will remember whether you acted or whether you waited. Make the choice you can live with. This is Chronicles of Currency. The window closes Monday. I'll see you on the other side. If this analysis brought you value, hit the subscribe button and ring the notification bell. The next few weeks will be critical, and I'll be publishing daily updates as the situation evolves. Drop a comment below telling me your current stack position. Are you adding this weekend? Are you holding? Are you concerned about the premium? Let me know. Share this video with someone who needs to see it before Monday. And remember, real money has no counterparty. Chronicles of Currency, out.